Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you guys annuity insurance and what is annuity insurance, what are some of the misconceptions with regarding an annuity insurance policy, and kind of how someone could leverage it for their retirement needs, whether that's on an accumulation stage or most importantly on an income stage. Why it's important to use an annuity in that specific type of situation, especially when someone's more terrified with speculations and terrified with the market, how annuities could be a nice little chassis to leave your monies into. And then also when it completely is just the wrong situation and when someone really should not be placing their monies into annuity contracts. And, so I want to kind of expose and talk about some good things as well. Now, one of the things why you hear annuity insurance, understand with annuity contracts, they could only be offered through insurance companies. So that's why it says retirement product through insurance companies. So you can't have a bank that's offering an annuity contract, just like you can't have an insurance company that's offering a bank product like a certificate of deposit, bank CD, money market account, etc. They have different tiers of safety. It's something known as a legal reserve structure, to make sure that if that specific company goes under on a fixed sense, if there's some sort of fixed account that's being handled through an annuity contract, there has to be tiers of safety that are put in place to make sure that these contracts are very safe, secure, protected. Now, why exactly would somebody want to leverage these types of contracts, these annuity plans for their retirement goal? And be mindful that you could place a whole slew of different sorts of either qualified retirement accounts. You could roll them over and create different types of IRA annuity contracts, or you could even use non-qualified monies like if you just sold a business, sold a house, and you have a large cash deposit, you could use those into annuity contracts as well. So you have the difference between qualified annuity plans versus non-qualified annuity plans. Now, an annuity is not just something that's different. It's not just some random plan that is 100% non-qualified. You could leverage 401k monies, and if you suffice certain criteria, such as you hit 59 and a half rule, such as you left that employer, you could go and roll them over into a specifically designed IRA contract that's established through an annuity. And the reason why individuals do that is for that safety aspect. So they understand, okay, maybe income, which is probably the most important aspect with somebody that's gearing up for retirement, is because they understand they're not going to be working anymore. They've established these different retirement savings, whether that's in cash accounts or qualified retirement accounts, and now they want to learn how to properly pull distributions from those accounts and make sure that when they start pulling distributions, that's money that they can never outlive. So many times individuals get set up or they kind of fall victim to thinking that an annuity contract is just a generic type of contract like it was in the 1950s, 1960s, 1970s, where you would only focus in on annuitization. And what I mean by that is annuity contracts are the opposite of life insurance. So with life insurance, it protects somebody from from dying too soon, meaning that if somebody passed away and they didn't hit retirement or they didn't hit their projected lifespan, well then they could leave a legacy. They could make sure that they have lump sums of money that get passed over to the beneficiaries if that person was to pass away in an accident or some sort of ailment. So annuity contracts were established to prevent somebody from living too long, meaning that prevent somebody from outliving their retirement accounts or monies that they geared for retirement. So the most basic sorts of annuity contracts, and understand annuity contracts are not established like this. You still have some that are established like that, but you've had so many different modifications of annuities, and this is the biggest misconception, is because someone thinks, oh, well, I've heard of an annuity back in the 1990s, and I wasn't interested back then, so therefore there's not going to be a difference now. And it's completely wrong. That's the complete wrong way of thinking. Just like anything, there's been innovations through any sort of technological advance, as well as with financial products as well, because it has to incorporate that ever-changing environment, the markets that are crashing, the low interest rate environment. So this is why you see these little appealing structures, these little appealing contracts that might pop up out of nowhere specifically for an individual situation. But back to my point, essentially old annuity contracts, you would give that company a lump sum of money, and then they would pay back that person in the form of lifetime income stream. So let's say if somebody's 60 years old and they handed an insurance company a very generic sort of immediate annuity, they would hand them $100,000. Well, maybe this person is a male age 60. Well, the insurance company would have actuarial tables and use mortality tables and say, okay, based upon our analysis, they should live into their early 80s, and therefore we'll pay them back maybe $5,000 every single year to the day that they pass away. So we understand from the client's perspective, they're receiving $5,000 each and every year. So even if they live past that 20 years, 5,000 times 20 years is their break point of 100 grand for easy math. Any year that they live past those 20 years is now pure profit to that individual. Well, the insurance company leverages the law of large numbers, so they understand with those sorts of contracts, yes, they could take $100,000 with this guy, and they could do that with thousands and millions of other people, and therefore protect their risk analysis to make sure that the mortality tables are always in their favor. So if this person passed away after 5 years, well, $25,000 got paid out to him, but now the insurance company keeps $75,000. Those were the old ways on how annuities used to work when you have a life-only single option, and it's been a lot different. You've had modifications to these types of contracts because it pissed a lot of people off. They didn't like that aspect. They understood that insurance companies were just getting rich hand over fist. Now, understand, you still have contracts out there, and even when you have, some of the newer annuities out there, like ones with income riders, you had variable annuities with income riders that were really attractive early 2000s, and then you had the hybrid annuities, fixed index annuities with income riders that came out after the 2008 market crash, and now you're starting to see all these companies jump on the bandwagon with these lifetime income products. At the end of the day, you still have a whole slew of smoke and mirrors, whether the company's doing that old annuitization option or they're just trying to mask it under something else with income riders. You have to distinguish which one is perfect for your situation in your particular area, and then what are the other 200 contracts that are just trying to, display the smoke and mirrors effect, giving you low returns and locking up your money where you can't access it. So with all this education that we try to do on a national basis through different publications, whether we write articles or whether we're explaining this online, it's always to hone in on your situation is going to be different than your neighbors. It's going to be different than your family members. You can leverage an annuity contract and you could say, okay, maybe I'm 60 years old. I'm going to retire in 5 years. Well, you could have a specifically designed IRA contract. Possibly a portion of that IRA would be in an IRA annuity contract that will provide lifetime income at age 65. So when you're dissecting, okay, what is the best route? We would determine, if you call into our agency, this is what we do, we're an independent agency, so we have proprietary strategies and we have all the relationships out there to make sure that we could say, okay, company A, they're trying to do a smoke and mirrors, as opposed to company B is going to be ideal off of the 1,200 different scenarios that come back. So if you're looking for max income plan, that could be a specific, that could be accomplished through an annuity contract. Let's say if you're looking for a safe accumulation and you don't care about income rider, you don't care about a death benefit rider, but you just essentially want to have your monies into a safe account that's going to gain when the market goes up, not lose when the market goes down, and you just want to have that safe, consistent power of compound interest growth to then eventually sporadically pull monies out, or just keep having these monies compound and then leave that as an inheritance, or just kind of leave it as a rainy day fund. There's different structures on that as well. Those are different sorts of annuity contracts. So you can't just look at an annuity contract, and when you say annuity insurance, it's an insurance company that offers an annuity. You have variations of different annuity contracts. Typically what we do is, we hone in on a lot of annuities because of what's going on with this current market environment. It's scary. Before, an individual was able to leverage a fixed account, like a bank CD or like a fixed annuity, get a nice double-digit interest return, such as 8%, 10%, 12%, live off of that interest for income, and then have their principal remaining at the end of that year. It was really simple. And if interest rates increase again, that could potentially be the way it is. But the downside to it is it's all based upon interest rate environment, and you have the interest rate risk, being established at that point in time. So you can't get a concrete plan when rates could change left and right. So when you're trying to establish correct annuity contracts or annuity insurance contracts, what you could do is say, okay, I understand like this individual at age 60, he might have, $30,000 in expenses that he needs to suffice, or he or she needs to suffice, together a couple at age 65. So they're 60 years old. They need a 5-year deferred product that's going to produce them $30,000 a year for income. Well, you could leverage annuity contracts that allow you to still control your monies, but provide a lifetime income rider on there as well. So maybe this might cost, $500,000, and this person has $700,000 in retirement assets. So out of that $500,000, they still, that 500,000 is still growing when the market goes up, not losing when the market goes down. That 500,000 will slowly be siphoned, each $30,000 deposit that's being triggered out. But eventually, if this account value goes down to $0, the whole purpose of the income rider was still to provide you lifetime income. So that's why with this scenario, the income rider will still be producing $30,000 of income even at that break-even point. Just like this break-even point was 20 years, this break-even point, 30,000. How long exactly would that take to get past that $500,000 mark? So, it's all about finding which contracts are the best in your particular area, which ones don't have these smoke and mirror fluffed up projections, so that you're honing in on the conversation of cash flow, and then you could leverage them properly. If you want to leverage it for retirement income, we established something known as laddering strategies. Let me clear off the screen real quick. When someone looks at this last term, and I say laddering strategies for retirement income and accumulation, understand, in order to have a comfortable retirement, be confident in retirement, you want to make sure that you're receiving lifetime income. Whether that's your pension income, Social Security income, or your retirement savings, you want to at least set aside the smallest amount of dollars that could accomplish that specific goal. So with an individual that might have $500,000 in retirement assets, if it costs him $150,000 to accomplish that income goal, well, now they could walk away with $350,000 and leave that in liquid accounts or speculative accounts, such as variable accounts, stocks, bonds, mutual funds, whatever their perspective, whatever floats their boat, essentially. With laddering strategies, the reason why that's important is because you could leverage specific contracts that are very good for a 5-year deferral and other contracts that are very good for a 10-year deferral. So what you could do is trigger a portion of the income in those 5 years, and then as their expenses are increasing with the cost of goods and services, known as inflation risk, you could also trigger income, smaller income increments to make sure that it's being laddered properly. And once again, so maybe initially you're getting that individual's getting the $30,000 goal, but then at age 65, and then at age 68, maybe it's going to 35,000, because then we're triggering another 5,000 to get triggered in 10 years. And so forth and so forth. So you could set up these little micro accounts to make sure you're receiving lifetime income. And you make sure that it's correlating exactly to your retirement income goal and your inflationary goal. If someone's leveraging annuity contracts for an accumulation side, well, understand, because annuity contracts have those legal reserve structures, and especially when you're looking more on the indexing strategies or more on the fixed strategies, it's going to be tied to some sort of interest rate environment. So if interest rates are low, well, then the returns are not going to be as favorable, but you could go into an indexing strategy that will provide gains when the market goes up and provide 0% gains whenever the market goes down. You could eliminate mutual fund related fees, advisor fees, sub-account fees, retirement account fees. You could eliminate that downward market loss potential. You could live off the interest that's gaining each and every year. So there's some neat ways on how to set up that accumulation stage properly. But understand, because you have a lower risk involved, typically they're going to be lower returns. Like if you had accounts with variable accounts, well, yeah, you're uncapped at what your gains are. So if the mutual fund gains 20%, you're going to receive a 20% bump into your account. But once again, on the contrary, if that mutual fund loses 20%, you don't have any sort of safety net there. You're going to lose 20%, or in 2008, the average portfolio lost 57%. Then we start incorporating the advisor fees that try to justify why you're in these mutual funds, or the mutual fund related fees through the fund manager. There's a whole slew of negatives that could go against your account. So there's ways on how you could be safe and consistent with annuity insurance contracts, or just annuity contracts, and you could specifically design them. For non-qualified monies, there's going to be particular products for that. For qualified monies, you want to use the smallest amount of dollars and only as much as necessary, so you could maximize the most amount of emergency funds and speculative investments, so that you could have fun in your retirement. You're not freaking out if the market goes down. So these are the different things that we try to show individuals on a daily basis. And at any point in time, if you guys find value in this, or you want to have at least a conversation and see, maybe what you're doing is correct, and maybe what you're doing is perfectly fine, and it's going to get your destination, it's going to make you accomplish your retirement goal. Well, it's good to at least have some good free advice on whether or not that is true, or whether or not you're interested in one annuity contract and you want to just have a second opinion saying, is this something that you guys would recommend? And, many times, and I was just dealing with a client recently about a week ago or 2 weeks ago, and he said, in the beginning, I wasn't going to call, but, you mentioned something at the end of your videos, and you said, what do you really have to lose is just get a second opinion. And if anything, you guys are going to be more educated on either what you're doing is correct, or, there might be some better options out there. But it's particular with whatever whatever your age is, whenever you're looking to retire, whatever you're looking to accumulate, all of those different factors all go into the same sort of process. And we have something that's an exclusive process known as the Retire Sharp Planning System, which just allows us to have basically a lot more chips, a lot more eggs in the baskets to therefore choose when we give our top 3 recommendations. We are A+ rated on the Better Business Bureau. We've always had good reviews, never had any complaints. But at the end of the day, if you guys really find value in this and you really just want a second opinion and want to at least speak with a specialist, we're available 24 hours a day, 7 days a week. Our 800 number is 1-800-566-1002. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thanks.